This panel is here is in Krakow because from my experience as a lawyer, I've noticed that now we have a big problem in Poland because most of the market used to be financed through stock exchange, but since the public money is no more here, we all need to learn how to raise the funds from other ways. And I invited a very diversified group of the investors looking at different stages of the development, and I would like to ask my guests, each of them, to introduce themselves, but also to tell what they are looking here for, and who would be ideal target, and if you would like to approach them, what you should represent.
Should we take this?
Okay, yeah.
Can you hear me well? No? Can you hear me now?
Yeah.
Okay. So thank you, Radzym, for having me. It's an absolute pleasure to be here. I'm Nicolas. I've been working in investment banking for roughly 10 years by now, and have been focusing my majority of my time on the digital consumer and entertainment area, and for the past 4 years really circling down on the gaming industry. So I'm working for Raymond James. It's a fairly large US institution with 25 billion in market cap, and we pride ourselves in being one of the most active and successful investment banks in the mid-market space. So here in Europe, and in particular in this area, you may have heard of two things that we have done recently. We've sold Bohemia Interactive to Base Systems. It has like a check routes. And we were heavily involved in a display deal, which was one of the largest Polish tech exits during the Corona time.
Who should approach you?
Exactly. So why am I here? So I'm basically looking for connections with companies or with founders primarily that are planning to hit the market in the coming months or years. And we are advising both on capital raises and exits. And in terms of capital raises, we would at least raise a quantum of 20 to 30 million in US dollars, because that's kind of the size where we feel like we can bring a lot of value to the table. And so in terms of exits, we usually pride ourselves in being very active in the 100 million to 2 billion enterprise value range. And yeah, that's kind of where we are, and really looking forward to the talk. Passing on.
Thank you, and I should say it is wonderful to be here. So my name's Nick Field. I'm CFO of Dovetail Games, which is part of Focus Entertainment. So we're a medium-sized UK-based developer-publisher of non-violent simulation games, best known for Train Sim World, which is the world-leading train simulation franchise with nearly 7 million downloads. So the reason I'm here is that we like the Polish market, we like the talent and expertise in simulation. We're very interested in publishing, particularly where you've got a good track record in simulation. And we're also interested in acquisition opportunities in the same area. So it's great to be here, and if you'd like to connect, please just ping me.
And who should approach you?
So successful game developers with non-violent simulation products that have proven traction. So that means it's not an idea, it's a product that people actually buy. And it can be small, it can be big. You know, we can work out how to work with you in either of those cases.
Hey guys, Curtis from Makers Fund, also happy to be here. Makers is a games VC, so we've been around for 6 or 7 years now, deploying out of our third fund, investing at seed and Series A, so early stage all across the games ecosystem, all across the world. Have probably 100 portfolio companies now, investing around $5 to $10 million in each of those, and then sometimes later following on. Everything from content to infrastructure to some consumer platforms that are adjacent to the games industry. In terms of what we are looking for, I'd say venture capital is not a fit for everyone. There's a lot of studios and a lot of game dev that just makes more sense for a publisher model. It's a different risk profile and a different, I'd say, outcome that you are aiming for. Venture is very much like go fast, go big, or go home. And so for us, what we're really looking for is typically multiplayer, live services, content, things that have the potential to be a forever game and the potential to really capture millions of users, billions of dollars. It's really the only way it makes sense for our model. So it's a different profile, but if that is what you are looking for, would love to chat and happy to share more.
Yeah, that's a great start to my next question. About VC perspective on the transactions. Could you please tell us more how VCs in general, but Makers Fund in particular, look at the deals?
Yeah, for sure. So in terms of what we're looking for, or like, what do you mean?
Yeah, well, what you're looking for, or how to prepare well to be spotted or to be financed by VC.
Yeah, for sure. So I think the biggest thing is just knowing your audience. Whether you're speaking to a publisher, a VC fund, private equity, knowing what they typically look for is, I think, really important in crafting your pitch. A lot of what I see and a lot of the reason conversations don't progress is because we are just genuinely not a mutual fit. So what we are looking for is really, how do you build something that has that massive scaling potential? So a single player premium game, I love playing them, not usually a fit for the venture model. And so the question we always ask is, how does this get to that massive scale? How do you get there? And what we look for, honestly, is a unique thesis on what you're building and why the market needs it, but then also the team. Poland is awesome for this because you guys have so much talent here, so less of a challenge in this market, but trying to understand why the team and the background that they have are well equipped to build towards whatever thesis it is that they're trying to present.
Curtis, I have one question, and I will also have this question for each of you. That I think that is a question from many people in the Polish game dev scene. Do you think that a VC, maybe like any other VC that you think it's good, has potential, would it be possible for them to invest in a public company or to invest in a public company in order to delist it? Because we have like many public companies in Poland.
Yeah, so I can't speak for all funds, but I would say it is possible. The more complicated the transaction, the more excited the investor needs to be to jump through those hoops. So if it is public and we are delisting it, it has been done before, but the bar is just higher versus a private company where the transaction is a little bit quicker and the team can get back to being focused on building. So it is possible, but ideally it is a private company with lots of room on the cap table so things can move quickly.
But it's not a deal breaker, so this is optimistic. Thank you.
Yes.
Nicolas, so how about the corporates and how to prepare to discussing with them and how to get funded by them?
Thank you. That's a wide-ranging question. So I think I'll break that down in the fundamentals we look at. So you got a product, and a product is a combination of the relationship of that product to its users and monetization and content, and that would be great. Obviously, if you have a successful business, that must be in a good place. So you need the metrics to demonstrate all those things, that users love the product, that you're monetizing them well. And the second is the team, because your product is here for whatever your product cycle is, but it's going to be a period of months or years. So when we buy a business forever. We're never looking to sell it. We want to own this for the next 100 years. In 100 years' time, want it to be 50 times the size it is now. And what that means is the team have to be able to make not just this product, but the product that comes after and that comes after that. So that's actually the harder part. It's quite well, I say quite easy. Sorry, I'm making it sound easy. Plenty of people have great products. Having a team that we as an acquirer can have confidence in to continue to deliver once we've given you a big pile of money to buy your business, that is actually both more difficult and also more difficult for us to evaluate from the outside. So it's a short answer, Radzym, but I hope that's useful.
And how about this investment in a public company or delisting it?
Pretty similar. I mean, we'd have no problem doing a public to private for the right opportunity. It would be about the business and the opportunity for us.
Okay, thank you. So Curtis is with venture capital funds, so the institutional investors that usually write smaller checks and invest in minorities. Nicolas works with the other fish in this pond, with the other animal or the other type of an institutional investor, being private equity funds. They write bigger checks, they invest in more mature companies. Very often they buy majority of the shares. So Nicolas, what is your experience in working with private equity investors? Like, are they looking at the GameDev scene? Would it be possible for them to invest in public companies, list them, how they see value in this industry?
So I would say that historically speaking, you have seen not that much activity from private equities in the gaming space, particularly on the content side. Now, ever since I really put my focus on the gaming industry, 4 years ago, I've been having hundreds of talks, I would say, with private equity firms, pitching them, hey, we're doing this. And on the side note, 80% of our company revenues comes from private equity firms. So we naturally have a lot of exchange with them. And over time, it became very clear that I'd say 90% of the tech-driven private equity firms are looking at that space. They want to understand it. They don't have any real angle to it. You know, they always have to have networks and better understanding of the fundamentals, but they have a general excitement of the industry, its fundamentals, and really want to take a deeper part into this. Now, particularly through the last 2 or 3 years, you've seen a couple of deals with private equity firms. There are a couple of in UK and in Germany, and what I want to say is, particularly on the public side of things, it really depends on the size of transaction you're looking at, right? When you have a private equity firm who wants just to delist a firm, it has to be very sizable ones, right? And yes, there have been very public, notable transactions in the space of people that tried to do that. Some of them did not go through, particularly not with private equities, but these funds also try to set up other aggregators. And that is an activity that has really picked up in pace over the past 3 to 6 months, I would say. There are various groups forming at the moment where a private equity firm wants to back a consolidator, right? And they would be the ones acquiring companies that may be listed or not, but it's really a size game.
Thank you. And now I would like to, one housekeeping comment. We are planning to have some questions from the audience, so if you feel that you have a question, please let us know, and we are ready to answer the questions. Curtis, you mentioned that you are looking for $1 billion companies. How to recognize the potential in a young organization, and what is the single thing that you are focusing the most, where you are reviewing potential targets?
Yeah, I will say as a lead-in, we are not particularly amazing at this. The venture model is one where you take many, many bets, and a lot of the outcomes are centered on a few of the companies you bet on. So I will lead in with saying it is an art, not a science, for sure. And sometimes it is just taking very big swings, and the market needs to break the right way, but that is what the venture model is there to support. This is why I would contrast it to something like a publisher, private equity, where they don't have the same risk profile, but they don't chase the same upside. How to recognize it? The biggest question for us is always, how big is this market? Like, if everything goes right, does this have the ingredients to be something that can go public for billions of dollars or be purchased for billions of dollars? And so earlier when I was saying single player premium content is typically not a fit for us as an example, the reason is that there's not a lot of examples historically of businesses that have taken in $5, $10, $15 million, released a single player premium title, and then generated hundreds of millions of dollars of revenue or been purchased for billions of dollars, just because the premium business model doesn't lend itself to that. Things like mobile typically have a little bit more scalability. Games as a service, multiplayer games that can go viral have a bit more scalability, but that is really the big question, is just like we look at precedent examples, we look at the market size, and the question we always ask is, what do you need to believe? And if those things pan out, can we see a path to that sort of outcome? So it's not a precise science, but that's how we think about it.
Okay, so the discussions about the money are always very difficult, and I know that they are difficult not only for the investors, but also for the companies and the funders. And I wanted to ask both of you, Nick, about how to prepare well to such a discussion and how to evaluate one's company to have a good answer for the investor when they approach and ask, what is the value of your business?
Thank you, Radzym. So that's a very difficult question to answer precisely, but I'll tell you how I think about it. So your business is worth what someone is willing to pay for it. And I know that's a very obvious statement, but from my perspective, if we're talking to a potential acquisition target, their value expectations are quite important to me as an initial filter for where this conversation is going to go. If their expectations are primarily centered around a fixed amount of money, what I know at the outset is that this is going to be quite a difficult company to buy, depending what that amount is. I think from a founder's point of view, and of course I would say this because my job to some extent is buying companies, but from a founder's point of view, if you focus on the best strategic fit and the things you and your team can do to maximize value together with your acquirer, that, as long as you have a competitive process and therefore you get more than one offer, which is what Nick here will talk about, that is how you find out what your company is worth. If you decide that there's a number you think it should be worth, and you go around telling people they have to pay you that number, that has a relatively low probability of success in my experience. And for us as an acquirer, that's I wouldn't say a red flag, but it's a bit of an amber flag that this is going to be a difficult deal to do. In terms of getting the deal done practically, that's a huge topic. So I think I'll pass over to Nick for the valuation point.
Thank you. And just one follow-up. Do you usually are first who says the price, or you wait for the sellers to tell their price?
We're normally pretty clear about value, actually. So we have an internal process, and it's important to us that we have a clear idea what we think this business is worth, because if we don't know that, how can we buy it?
So then the funders need to convince you if they feel that it's not enough, that your valuation should be bigger.
Look, it's a negotiation. I mean, it is natural they will feel it should be higher and we will feel it should be slightly lower. But the fundamentally, you have to start somewhere, and that's why we have an internal valuation process. That means we know we're starting in a range we can transact at.
Okay, thank you. And sometimes, because I understand that now on the market, the very popular mechanism is the earnout. So this is a kind of a deferred payment that is depending on certain business conditions, or that's based on for example, someone is developing a game and this is not complete at the moment of the transaction, and they say, look, if this game earns X, then the sellers of the company will have some additional remuneration for their shares. And do you meet this mechanism often now?
Yes, absolutely. I think it's one of the core mechanisms. But before I go into that, I would kind of take this more broadly. In general, whenever a founder is being approached by any sort of acquirer, it's never the best offer you will get. That's for sure, right? You can go down that route, you can make a deal, you probably will feel like you've done a good job, but chances are 99% that you've been highly underpaid for what we've been building. So I think, and that's of course my core thinking and what I'm doing day by day, but hiring a professional advisor is absolute key for you to maximize on value and your further ideas on what you want to do with the business. They will also be able to give you a rough indication of what your business should be worth, right? So there are various methods you can apply here. There are various public comparables and private comparables, but you need to have a specialized advisor who does nothing else in his usual day that can give you a proper indication of what your company may be worth. Now, does it make sense that it will always be hitting 100%? No, right? So it's a process that will be developed over time, and what I'm trying to say is always having a structured process will enable you to maximize whatever goal you may have. And in terms of earnouts, yes, it's highly dependent on which kind of buyer you're talking to. Is it a strategic? Is it a private equity firm, right? Earnouts, historically speaking, in the European region, they've reached, on average, depending on a subsector, 50 to 60%. So it's a very high portion of that. Now, if you're selling to a strategic, that's a very nice tool for them to fund their own acquisition, and that's very fair. If you usually talk to private equity firms, and that's basically my core idea, that this entire industry opens up itself more to private equity firms, you will not only have an earnout component, but you will also have a significant reinvestment, right? So you don't have 2 exits, like today and later when the earnout comes, but you will most likely have 3. And that's a very interesting model, which usually elevates your own cash proceeds you may have over a longer period of time. And yes, I think one thing to mention, it's probably obvious for most of you guys, but if you're selling your company, or if you want to step down from the company and you are the majority holder and you're very close to the business, it's almost impossible that you will get out of the company and being, invested in everything just by doing a deal. Every investor wants, and the strategic as well, wants you to further drive the business plan that you're presenting, and earnouts, reinvestments are the best structure to reinforce positive incentive alignment to maximize deal value for both parties.
Thank you. So I think that we all agree that this is very important to prepare, because you usually deal with the very experienced people on the other side of the table, and it's smart to be well advised just to prepare better. And I wanted to ask you about epic fails and about the results of not preparing so much to the process. Could you tell like one war story, starting from Curtis?
I mean, I don't know that any of them are like super spectacular. I think for us, it just comes back to, do you know the audience that you are pitching to? If you approach us and you are looking for a publisher and we are not a publisher, and you would be shocked how often this happens. Like my Pine inbox is like 20 of these. It's not a good use of either of our times, but I don't think any of them are like epic fails. It's just like a 30-minute meeting where we shake hands, say it's not a fit, and move on.
Okay, thanks. Nick, you told me that you have a great story.
I do, yeah. I thought hard about this, because obviously what you try to do is avoid epic fails, and I've been trying to do that for most of my career. There is one which I think is the most epic, and it's a good example of why, as a principal, so as a founder, you should remain involved in the detail when you are selling your company. So this was, it was 2 or 3 years ago. It was actually during COVID, so it was all done remotely. I was selling a business in the UK to a Nordic publishing company based in Finland, so it's not in the game sector. And the deal was fine. It was totally agreed. Economic terms were good. Everyone was happy. And we had 2 exceptionally difficult legal advisors. So the lesson here is you should use Radzym. But the legal negotiation dragged on for 6-8 weeks. Got really hung up on some very tedious points that fundamentally did not matter to either of the principals at all. Mattered to the lawyers, mattered to nobody else. During that period, things had changed on both sides of the table, and at the end of that period, the deal then fell over and never happened. So that was to me it was a bit of a tragedy because it was a perfectly sensible deal, which didn't happen because of a mere technicality. So that's my educational epic fail. Keep close to detail and talk to your lawyers.
Well, to me, it's you see fails all the time, and I mean, being in the transaction industry, everything's a fail that does not transact at the end of the day, because people and various people working on these transactions do pay a lot of time, sweat, and energy to prepare a company, to go through due diligence and whatever, pay advisors, and if it doesn't go through, it's a very bad thing. And now, a founder may say, hey, that's a natural thing to go through, but if your company is up for sale for a too long period of a time, it always has a bad taste to a new investor joining the party. Because then they will always feel, okay, there's so many people that have already looked at it and that did not like whatever part of it, so it has to be bad, right? So again, what I'm trying to say is make a structured process and go all in and try to strike a deal. And not say, okay, let's wait 2 or 3 months and then redo it something, because then you are a burned asset in a way, and people don't want to touch you really.
Do you have any questions? Look. Okay.
Hi, I'm Mike. I'm working with Japanese gaming industry, and the point about Nick and legal advisors having their own little, insignificant battles, like. It seems like it happens quite a lot. Like one M&A I was involved in, like it was also had this, bitter episode of meaningless, legal discussions that none of us could really understand what this is about. So, what would you say is the good solution for such choke point?
I'm probably less qualified than either Radzym or Nick to answer that question, actually, but I'll answer it briefly. I think common sense does apply. There are legal details which do matter to lawyers, but if it cannot be explained to you and you can't understand it, it probably doesn't matter.
Very small ad, because I've had a number of these where lawyers just have their own infighting and it's meaningless. Wherever possible, just go directly to your counterparty at the other business and keep the lawyers in the loop. But when lawyers are speaking to lawyers, they're just running up fees generally sometimes on terms that, yeah, exactly. And so I try to just have direct, like, business-to-business conversations wherever possible, so that you can very quickly squash things that are insignificant.
Or you can also, try to ask your friends whether they have any lawyer that they worked with and that was pragmatic and focused on making the deal and not, like, I don't know, writing a thesis about some interesting stuff about GameDev law, because it also happens.
There's always good and bad lawyers. Usually you pay what you get what you pay for, right? So saving on them is usually a bad idea, but instructing them very clearly what you expect from them is probably the best way. And also inserting some sort of cap on their fee structure helps driving their own efficiency.
Do you have any other question?
I have 2 questions, so I'm going to hold on to the mic. So the first question, when you consider an investment, you said you look at the company and the product, right? If you look at the product, can you be more specific? What kind of things you're looking at? You mentioned something about multiplayer, so technological advancement, the life cycle, but do you have a checklist, like a very concrete checklist?
We don't in particular. Beyond the scalability and market size piece on the product, it's for content generally just like a quality bar, and is there something novel or innovative going on, but nothing, no checklist. I don't know if you.
I think it's very case by case. It really depends what kind of product you're looking at. I mean, we do premium simulation games for PC and console, so retention rates, review scores, player satisfaction, that's super important. But for a mobile developer, that would be completely different. So I think Nick may be able to talk to the fact that if you need a clear view on what matters for your business ahead of a process, then what you need is an expert who can tell you what people will look at for your product.
Yeah, okay. So maybe I should have been more specific. I'm talking about an upcoming product, right? So not the products which already exist, which have a track record of the reviews and the users, but let's say a product in development. Does it change? Would that change your answer? No.
I think then for us it becomes, it's then really a creative process, isn't it? And then that's typically something we would look at more as a publishing relationship or a publishing relationship with an investment. So that's kind of the traditional video games greenlight model for us.
So, I would just like to add that it highly depends on every subsector that you are working in, right? So every subsector has its trends, and at the end of the day, if you have a sizable business, saying you're generating 10 million EBITDA, there is probably some substance to it what you're building, right? If you're talking about future projects, just from my experience and the type of investors that we deal with, the future is always a great thing to talk about, and yes, you do want to spend time with that. But an investor always wants to understand your history, where your team comes from, what you've been doing, what your capabilities are, your demonstrated capabilities, and most importantly, data points that you can prove it. Where I'm trying to go to is, don't be chasing ambulances, right? So right now, AI is the hot thing. Don't center your future all around AI. You have a very clear roadmap, you execute on that, and if it works out, great. You may use these things as additional tools to make certain things or aspects better, but it's not the core of the center, because by doing that, you will be always too late to the party, right? Last year it was NFTs, the year before that it was crypto. So it's constantly changing so quickly, and for any sizable investor to involve with you, it takes a lot of demonstrated financials in order to convince them to pay you millions and millions of dollars.
Thank you. I have a second question, a quick one. So you invested the companies at different stage, right? At the early stage, there was a question about the public companies as well. What about companies in a pre-IPO stage? Is that an additional benefit for you, knowing that you will have an option to exit, or it's completely irrelevant for your decision? So it doesn't.
So what was the question?
Whether the companies at the pre-IPO stage, right? The companies which kind of completed the process and now waiting for, I don't know, the markets to unfreeze, for example. Is that an additional benefit for you as the decision makers when you look at any investment, considering that you'll have a sure way to exit the investment in the near future? Or is that completely irrelevant in those uncertain times? I'm asking about because the times are quite uncertain, and it's very difficult to exit the investments as easy as it used to be. So
I would say that I think it really depends on the country you're talking to in terms of pre-IPO stage, right? And yes, Poland did have a longer period of time where earlier stage companies went IPO and they went through the process and documentation phase. Does it put them at a huge advantage? I would say not really, because IPO investors typically are different investors than buyout investors. Traditional buyout funds won't usually participate in IPOs because they want to have majority ownership. They want to have certain legal rights in place that usually don't go so well with the public markets. But at the end of the day, it really depends on the case, right? You would have to go case by case, yeah. I think that's it.
Say for non-buyout investors, minority investors, two things. One is we always are trying to ask the question, how does this exit and when? But and pre-IPO, it's still not certain. So you have to be comfortable with a variety of outcomes. The second thing is the time horizon of that relationship. For us, we invest in companies, it's 5-10 years before we exit, and so if it is in 2 years, that's great, but we take a pretty long view, and I think most venture funds take a 5-10 year life cycle view.
And they accept a bigger risk, so for you it's not so important to know that in, I don't know, 7 months there will be IPO, but instead you expect a higher rate of return. So you expect the company to grow like multiple times to justify this investment.
100%, yeah. You saw a bit of it with the token rounds that were happening, and I think it was a little predatory what some VCs were doing, where they were trying to put money in at favorable discounts and then get it out quickly to public investors. That's not generally how most funds will operate in our space.
So I think that, for example, the idea that someone has a company, it's very close to IPO, so there is a way to exit this company in a not very long time, probably would work best, if I can imagine, for like high net individuals, that the people that have some money on their bank account, it's better for them, like, you know, to invest for a very short time, maybe not the highest multiple, but not a big risk than with respect to the institutional investors. Are there any other questions?
This one is to Curtis in particular. When you do investments, how is your opinion on implementing ESOP structures, but for key employers, not for founders?
Yeah, always. We do 10 is like the lowest, sometimes 15, 20, 25. It really depends on the cap table, but for us, we want there to be, like, working at a venture-backed startup is very hard. You often get paid less than you would if you worked at a large strategic. It's stressful, the hours are longer, and so we want there to be adequate incentive and reward when things work out. And that should be all the way from the founding team all the way down. So yeah, very, very supportive of ESOP, and generally would say it's a red flag if we invest in a team and they're like, we don't want any of our employees incentivized with equity.
Are there any other questions? Okay, so coming back to my, oh, sorry.
Thanks. So I have one question actually, and I think that's quite common problem recently in Poland. Do you guys have like any case study about like fixing broken cap table? Because what I noticed, like especially in Polish game market, like it's very common that, you know, you have like whatever 10 business angels who took too much equity. I mean, like the team is right, like the product is great, you know, the market size is great and so on. So everything is like great, but the cap table, when you look at the cap table, it's like broken. Like, do you have like any like case studies how to fix it? And
yeah, so a couple thoughts. One is similar to the comment earlier. It is not a deal killer, but it is a hurdle to jump over, and so be upfront. I mean, in your first interaction, don't say, hi, nice to meet you, our cap table is broken, but like early on say, hey, this is something we're gonna have to work through, and that will go a long way in just establishing trust up front. But it's definitely doable, and we've done it through ESOP quite often and founder grants. But for us, like a broken cap table just means that the people running the business don't have enough equity or ownership to be incentivized properly or rewarded properly, and there's ways to do that through ESOP and founder grants, in our case.
Yeah, thank you. That's, I mean, it's not unusual, particularly where you've got people who've been through several rounds of funding, maybe they've been diluted more than, you know, more than would be ideal. From our point of view, so if it's an investment, if it's a growth investment, then exactly as Curtis said, we can fix that if we're making a strategic investment in roughly the same way. Obviously, the easiest way to deal with it, you know, as long as the economics work, is actually just to buy out the passive shareholders, you know, do 100% exit, clean the cap table up, and then put incentives in place for the new team, which absolutely is something that we're comfortable doing for the right product. And that's why I say it's about the team and the product. And we can fix structural problems as long as those are in a good place.
Are there any other? No. Okay. So we're running out of time, but maybe one additional question. I think that the Polish ecosystem is still building the international relations and learning how to interact with the foreign players. And I wanted to ask you about one advice: how to make the good first step, and how to do the first interaction, or how to cross the border for the first time. For example, with respect to you, is it better to cold email or to look for someone who could make an intro? How to approach you if there is no pine, there is no other opportunity to do this?
Warm intros are always best, but not always available. I would say if you are deliberate in your reach out and why you want to speak, most people will answer your email, or I will at least. If it's, hey, I want to speak for this reason and it's relevant, you get a lot of spam, copy paste emails to 100 people, and those don't work. So that would be the first thing I'd say. The second thing I'd say is just treat it like a relationship and like a human on the other side of the email thread or on the other side of the table, where you genuinely want to see if you want to work with them. VCs are not ATMs. So see if you want to partner with them, because they're often going to sit on your board. They're going to work with you for 5+ years. You should be selective about that. And it's kind of a yellow flag if you are not asking any questions about us and what we are like to work with, because you should be proud of the business you're building and deliberate about who you choose to bring in.
Okay, thank you.
Yeah, so from our point of view, I think we've got, well, I'd take exactly the same approach. If you approach us and clearly articulate why you'd like to talk to us and what the opportunity is, then we will talk to you. What I would say is it is very helpful if we have already heard of your business. So, if we have heard of your product, if your product is clearly successful and we know about it, that's going to get a lot more time internally than if we've never heard of it before. So doing all the things that you probably do anyway, one, make your product super successful, two, tell everyone about it being super successful, that is always helpful.
Okay, so now Nicolas, but this is important to understand that his work is to let the people that want to sell the company know what should be the right price and who would be the best investor. So, for example, this is a great way to start talking to other people from other companies, other countries that otherwise it might be difficult to approach. But yeah, I would welcome your view on this.
So yeah, quick answer is write me an email. Yeah, it says it's up there. Now, what? There are people, just like myself, and there are a few others, particularly in Europe, with a focus on the gaming industry, but there are people that are specialized in just doing transaction in that space, right? And after a certain size threshold, it makes a ton of sense for you to engage with these people, right? You cannot have these personal relationships that Curtis just mentioned. Those are great, but at a certain level, there are so many companies, there are so many highly professionalized institutions, you cannot maintain connections to all of them. So I would say really work through an agent, just like us, that can help you drive also your interests and serve as a proper tool in order to make all the hard calls and have those mean conversations. I'm saying mean because at some point you need to push the investors in order to maximize your interests, right? And you as a founder will, or as a management team, you will be working with that investor for a longer period of time. Now, if you behave in a certain improper way, that will kind of destroy your relationship from the beginning, right? And having a bad guy on board that can make all the tough shots and all of that has a lot of experience will really help you drive valuations. And I mean, there's also a bunch of evidence to this, right? Usually when we get asked by a founder, hey, I want to do something here, I want to sell, I want to raise capital, whatever, we are usually incentivized to hit a certain enterprise value mark, right? And after that mark, we are getting paid a lot more, because if a transaction doesn't get completed, we don't get any money. If a transaction gets completed at a certain size threshold, then we get like our base fee, right? But when we look at our say past 5 years or so, we were able to hit 9 out of 10 times the ratchet, right? That means we were able to massively overachieve the valuation expectations that were initially set out by the founders, and that's perfectly alignment of interests of all parties involved.
Okay, thank you. Thanks for sharing your insight with us, and our panelists are with us for the entire day, so please don't hesitate to come and ask and schedule your meetings with them through Pine. Thank you guys. Thank you.